In 2012, GameStop revenues topped $9.5 billion. Shortly thereafter, the stock hit an all time high of $51 a share. That was in the fall of 2013. Now, coincidentally, that was just about the last time that I entered a GameStop location. My son was 11, and for him, GameStop was the center of the universe at the time. But my son and countless others in his generation quickly graduated from the in person experience of GameStop to the digital experience we expect today. GameStop revenues suffered, and the stock price declined. Stock hit an all time low of $3.77 in July of 2020. Then in the fall of 2020, something strange started happening. Stock started to go up a lot. It doubled in 60 days, doubled again in 8 days, doubled again the next day, and crescendoed to a high of $486 a share. Now, this massive increase wasn't driven by an earnings beat or a restructuring that unlocked profit or even a potential buyout or asset sale. No, the market movers for GameStop were, at least in part, a band of message board operators trading on a relatively new platform in a coordinated fashion. And GameStop was hardly alone. An entire group of stocks whose halcyon days appeared to be in the rearview mirror caught fire. These so called meme stocks used a single weapon, viral activity fueled by social media, to achieve new highs. Wall Street reaction was predictable. They scoffed at the trend, just another tulip bulb craze, destined to end quickly and poorly. We didn't feel comfortable with this casual dismissal of the trend. It seemed like there was more to the story, more questions to be answered, more lessons to be learned. So Scott Wimmer, our Director of Client Success, found some enlightening research on elasticity in the market that we want to share with you. And welcome to Scott Wimmer. I understand you did some interesting research on the subject. Would you like to share some of those details with us?
Yeah, sure can. We found 2 research papers. Both of them were published in the Swiss Finance Institute Research Paper Series. And they really touched on the idea that the rise of Robinhood and retail investors over the last few years are having actually a pretty strong impact on markets. And we've seen that this year with the likes of GameStop and recently AMC stocks. So we wanted to do some research on what's really causing that.
And so, I know Robinhood's a fairly new platform, but is this really a new phenomenon in terms of the stock market?
Yes and no. Yes, in the sense that Robinhood and the platforms of free trading are relatively new. Just last year, Robinhood doubled its usage as far as the number of accounts it had open. But stock price manipulation has been going on for quite some time, and there's actually a funny story. About 20 years ago in 2000, there was a New Jersey high school student who managed to take $270,000 from investors by buying thinly traded stocks and then going on internet blogs and posting fake news about them. So nothing new there.
And so you've got a New Jersey teenager that can move the market, but is it possible for a coordinated and small group to, actually effectively move, lots of different stock prices, and if so, how do they do it?
Yeah, so one of the new hypotheses that is out there, and one of the papers talked about, is called the inelastic market hypothesis. And really what that means, what inelasticity means, is that prices behave disproportionate to the amount of capital being invested, either into or out of a stock. So a way to think about this is that a lot of money over the last 20, 30, 40 years has been moved into institutions and passive indexing, which is very passive in nature, doesn't trade very often, is not very active. So think of it as though you have a stock with 100 shares. Well, 60 or 70 of those shares may not really trade that much. So that leaves a very small number of shares out there, and you have a group like Robinhood that herds into a single stock, and they can go in there, buy the stock up, and have a big impact on the price.
And so you've got these people that can herd into that 30% and make a big impact by, basically coordinating together. So, what can we learn from that? Is this a phenomenon that's specific to a small subset of stocks, or is it something that's actually where the market as a whole is more susceptible, or are there more stocks than just the meme stocks that are being impacted by this?
Yeah, it's actually pretty interesting. Obviously GameStop got all the news and the attention earlier this year, but Robinhood traders have been having a much larger and broader impact on stocks across the market. For example, the paper talks about Ford Motor Company. It would have experienced negative returns in the second quarter of 2020 had Robinhood traders not been investing in the stock, but it actually had a quite positive return, and that was because of Robinhood traders being there. And Carnival Cruise lines is another example. Airline stocks, General Electric, Disney, those are some that are cited in the paper as being heavily purchased by Robinhood.
And so it's happening in GameStop, it's happening in Disney, it's happening in Ford. What can we learn? Bottom line, how can we use this knowledge to become better investors?
Yeah, I think the first point is that events like this are not going to stop happening anytime soon. And if anything, they could be happening more often going forward. And that I think when you look at these events, you see classic behavioral biases occurring with the investors. They herd into these stocks, they have a fear of missing out, they see massive profits, and they think they can get in and get out real quick. The research kind of notes that a lot of these stocks have negative returns, though, in the long run. So most investors are going to lose if they get involved in these things. I think finally you also have to recognize that platforms such as Robinhood are here to stay, and they're having a major impact on the markets. Whether or not you think that's good or bad, we just have to be cognizant of it and aware of what's going on out there in the marketplace.
Well, Scott, thank you so much, and we look forward to reading your full report.
Sounds good. Thanks.
The research and the overall conclusions are just another example of how the market operates. The obvious moves often hide the more prevalent ones. The lead story often buries the real story. It pays to be curious. Rewards accrue to the open-minded. Change is inevitable, and we could choose to ignore it, or we can choose to learn from it. Now, if you'd like to read Scott's full report on market inelasticity, including the references to the relevant research that we cited, please visit the blog portion of our website at siliconhillswealth.com. If you'd like to check out our other voice content, please visit us at Voice from the Hills on SoundCloud. And for regular and timely updates, please remember to ask Alexa for the latest update from Silicon Hills. Thank you.